Yeah, you're seeing this right. I'm down a total of $27,000 on both of these trades on UnitedHealth so far. And these trades were just placed about a week ago or so. And today's video is going to be very different than the videos I normally make. Usually you'll see, and also videos that you see period online, because you'll see everyone talking about how much they're making with trading and all of that stuff and all the profitable trades and so on. But today's video is going to be a little different. I don't have anything scripted, don't really have a lot of talking points. I just wanted to have this discussion and just talk to you guys about how to save trades when they go horribly wrong, okay? And this trade with UnitedHealth, right? I'm down $11,000 on this particular cash secured put, and on this poor man's covered call, these leaps, I'm down $16,000. But I'm not panicking because I've got a game plan. I'm making this video for my Patreon members, but I wanted to open this up to my YouTube audience as well, so I could just turn this into a teachable moment to kind of show you guys when things go wrong, and they will, how to manage your trades, how to turn horribly losing trades into profitable ones, and the mindset that kind of comes along with it. I've been in this situation before, and I'm sure I'll be in this situation again. No biggie. Last time I was in this situation, I turned a 50% drop in a stock into being up over 100% within, I think, 3 years. The market rewards patience. And if you guys want to see an example of that, just look at what's happened to the S&P 500 within the last month and a half, right? From its huge decline to coming back up. This is when people were really panic selling and trying to jump ship because they're new and don't know what's going on. But the market rewards patience. It did during the big recession of '08. It did it during the COVID crash. It did it recently because of the whole Liberation Day stuff. And the traders and the investors that stayed put and stayed patient are doing okay. But the ones that panic sold are doing horribly and regretting what they did. Taking the hit that it has in the last few days with all the news, I'm not panicking. This is what I'm down so far, but these are unrealized losses, right? I haven't taken a loss. You don't take a loss until you close out a position. So I don't consider these losses, but I do need to save these trades, and I'm going to show you guys step by step what my thought process and what my game plan is of how I'm going to do this, okay? So here's a little backstory. UnitedHealth was here. Let me put on my indicators that I use. So it's Luxalgo Premium. You guys want to check it out? Link in the description below. Amazing premium indicator. I use it for all my trading. It is amazing. So when I was looking at my indicators for this, the main thing I wanted to kind of get into a position with UnitedHealth because it had taken a huge hit from last month to this month, right? Down a ridiculous amount. From $600, it was down to about $400 when I got into this trade. And this particular trade was a cash secured put. I wanted to pick up shares. I wanted to pick up 100 shares of UnitedHealth. So I sold one put, collected $8.04 a share in premium, so $800 in premium. And I'm like, if it dips down, I don't mind buying it. And I selected the $480 strike. And the reason why I did that is when I was looking at the charts, there was bullish divergence. It was very oversold. So I was thinking it was going to, come back up or stay flat for a little bit, but it decided to completely tank. And this particular strategy of the bullish divergence to sell cash secured puts has been extremely profitable for me. Pick up random stuff. Bullish divergence right here. Stock pop, Amazon popped up. Let's look at Nvidia. Same thing, right? Bullish divergence, stock popped up. Let's even look at retail. Let's look at Target, okay? Bullish divergence, stock popped up. So I was like, you know what? With UnitedHealth being as big as it is, hopefully it'll do the same. And if not, I don't mind owning shares of UnitedHealth at 380. And then all hell broke loose, right? Right here, announcement that they're canceling guidance. The CEO stepped down all of a sudden. I'm like, all right, cool. News. It happens. And then yesterday evening, another big drop because now the DOJ, Department of Justice, has started an investigation on fraud with UnitedHealth. I'm like, all right, cool. More news. Big whoop. If you go back 5 years, the DOJ has opened up multiple investigations on Google, Apple, you name a company, they're going to do their stuff. So it's whatever, Meta, done all of that. Doesn't really matter. So what's the game plan now? I'm already way deep in the money, right? Because I wanted to pick these shares up at $380. Right now they're at $260. That's $100 a share below the strike price that I wanted to buy it at. But there's also a month left till expiration. Today is May 15th when I'm recording this. This is for June 20th, so I still have well over a month to see if it kind of bounces up a little bit from the news or whatever happens. But it is highly unlikely that it's going to bounce back up above 380 in a month after all that's happened, okay? That's just how it goes. If I get a sign, I'm going to see, depending on where the stock price is closer to expiration, there's two options. Option number one is roll it out to a safer strike price that I'm comfortable with, where I'm at least break even on the premium that I've collected and break even on the trade. If not, I don't mind getting assigned at 380. I'm perfectly fine with that. Okay. Even if it's at 100, even if I was to get assigned today at 260, like if I had to buy these shares at 380 and it's worth 260 where I take that instant unrealized loss, it's perfectly fine because I can continue selling covered calls at certain levels to keep lowering my cost basis. And this is how I've turned a 50% drop in a stock into a 100% gain. And that's what I'm going to get into next. And I'll show you guys how I did that and then talk about my step-by-step plan on United. So let's take a trip down memory lane. And for this, we're going to look at SoFi. I'm going to bring this up. Here's the history for SoFi in my Schwab account. I'm going to go back down and let me show you guys. I'm not going to show you my cost basis yet because that's going to surprise you guys. Let's go back down all the way to 2022. Okay, February of 2022. This is when I started selling cash secured puts on SoFi 3 years ago. Now, let's look at SoFi stock back in 2022 when I got into this trade. It was February 7th, 2022. So let's get into February. There we go. Monday, February 7th, 2022. Right here is when I sold cash secured puts on SoFi for $11 strike price. The stock was trading around $12. I'm like, if it drops to 11, I'll buy it. You know, it looks pretty good. It's been going down a lot, right? It had gone down from $23 all the way to $12. I'm like, hey, if I can even pick it up at 11, I'll be happy. So I started selling cash secured puts, and behold, it was working out great. I was collecting premium. I was doing all of that stuff. I was collecting premium. I got assigned right here on March 11th. Okay, let's go back. March 11th is when I got assigned. Went down, and I got assigned at $11 when the stock was at $8.78. So I was instantly negative because I got assigned at $11, so I had to buy it. I was obligated to buy it at $11, but the stock price was $8.78. I'm like, all right, cool, whatever. I started selling covered calls, continued to sell covered calls. But at one point, I was assigned at $11, and right here, by May of 2022, SoFi was down to $5. Yeah, well, it was actually, for a point, it was under $5. It was at $4.88. We're talking close to 60% down from what I had paid for it. But I believe in my system. I believe in the wheel strategy because it has been proven to work over and over and over and over again. I continued selling covered calls. Right? You guys see this. I was selling covered calls. I was closing them out for profits. I was lowering my cost basis. I kept selling covered calls, $8, right? You see all of this? And I just kept doing it all the way. It's just not going anywhere. I'm still way below my cost basis. Let's mark this. Okay? $11 is what I was assigned at. So it's still under, but it's just staying flat. I'm collecting premium, lowering my cost basis. It's still, right? Finally, 2023, it went above my cost basis, right? Not my cost basis, but what my strike was. But SoFi, I wanted to hang on for long term. I'm still actually, here's the thing, okay? Let me show this to you guys. This is my SoFi position right now. I still own the same 1,000 shares. I'm up 30% on these. But in the beginning of the video, I said I'm up way over 30%. I said I'm up over 100% on this trade, right? Let me show you guys how. So as time went on, it dipped again, went all the way down to $6 again, and it kept going down. I kept selling covered calls. It went up, down, all of this stuff, and this is where it's at today, okay? It is at close to $14 right now as of today. I was assigned at $11. It actually shows my cost basis as $10.53 because it took the initial premium for my cash secured put, and that's what it factored it out to, but this is not my cost basis. And this is where it gets interesting. This is how I turned that 50% dip in that stock that went from $11 to $5, okay, into over 100% return. So now, you guys see this, right? I've been selling covered calls on this thing for the last 3 years. Here's my actual, from all the premium that I've collected, here's my actual cost basis. Under $6 a share. Yeah. So if I was to sell SoFi right now at $13.66 and my cost basis is around $6, I am up over 100% on a trade that eventually, in the first place, when I had gotten assigned, I was down big on. But that was unrealized losses. And those aren't realized. It is not a loss until that position is closed. Hopefully that kind of makes some sense, where even though I was assigned at $11, stock went all the way down to $5, and it just stayed flat for the longest time, but I stuck to my plan. I kept selling covered calls and kept doing that. And because of that, I'm up over 100% on this position because my cost basis is $6 and the stock right now is trading at $13.86. And I still have a covered call on it that's rolled out all the way to January of 2026 at the $15 level, because I just want to hang on to the stock and keep collecting premium as it continues to go up and down or whatever it does. Okay. So now let's get back to United. So what's my plan for United now that United has done what it's done? UnitedHealth has done what it's done. One of the big, and I told you guys in the beginning, so I hope you guys don't mind that. I'm just going to be rambling in this video because I just want to get some points across to my members, okay? And you guys on YouTube are privileged to that information today because I just want to open it up to the world. So with United, the first thing is when I research United, even though it's taken such a huge hit in its market cap because of the decline that it's had, right? Even at current levels right now, the current price of it right now, it is still has a market cap of $239 billion, almost $240 billion. It is still the largest company in the healthcare plans industry. It is still the largest. It's about as large as the next three biggest companies combined, okay? So it's still a huge company. So I'm not worried. I'm not worried for it to be going bankrupt anytime soon. Number two, and this is where a lot of beginner traders mess up. I'm not over leveraged on this. I'm not freaking out because even if I take a full loss on this, which would be $38,000, which most likely won't happen because for me to lose $38,000 on this trade, United Healthcare would have to go bankrupt and be at $0. Okay? Not worried about that. With the poor man's covered call, with the leap options that I've purchased that I'm selling covered calls against, this still has 2 years to expiration. That's why I picked an expiration that was 2 years out, because it gives me 2 years to keep selling covered calls on this to lower my cost basis if it doesn't come back up. So I did 2 contracts on that. Each contract cost me almost $15,000, right? $14,861 per contract. So even if this goes to zero and expires worthless, that's $30,000. It's a big loss? Yes, it is a big loss, but it's still a small portion of my portfolio where it's not going to devastate me. It's not going to hurt me. And this is where a lot of traders kind of get hurt and start whining about one trade going wrong, is because they're over leveraged. They're not position sizing the right way for each trade. So even if this was to go to zero, big whoop. I'll take an L because I've made way more than that on other trades for me to cry over one trade going horribly wrong because of news I have no control over. But I don't plan on letting this go to zero because I've got a game plan for that I'm going to share with you guys right now too. So let's talk about the cash secured put first. If I get assigned whatever price that this is at, the plan is to sell weekly covered calls on this to maximize on the premium collected. I usually do 30 to 45 days out, but that's if a trade is going fairly well and I just want to be super passive about it. This I'm going to need to get a little bit more active on, which I'm perfectly fine with because I don't want to lose $50,000 to $60,000 in between both of these trades. So I'll get a little bit more active, which is perfectly fine because even being active isn't as active. So how do I plan on selling weekly covered calls on this? Using my trusty Lux Algo Premium Indicator, okay? But I'm going to be doing that on the 5-minute chart. So let's load that up. So the plan is going to look at UNH on a daily basis and see whenever Lux Algo's oscillator tells me that it's overbought and a white dot comes up, I'm going to sell a covered call that's probably got a 10 delta. Super low delta because that tells me there's a 90% chance it's going to expire out of the money. I'll get to keep all the premium. And in the current situation right now that United is in, all right, today's already Thursday, so tomorrow's expiration doesn't really make any sense, right? And I look at a 90% chance of success, right? That's still $2.31 a contract, which is $231 in premium. And if that was to happen, United would be going from 264 to 312, which is a huge jump, which would be good for my overall position. So weekly with a 0.10, 0.08, whatever it is, because I want high probability, but I want to keep collecting premium. The question that comes up is, why not do the 30 to 45 days out? Now, if I was to do, say, 45 days out, 43 days right here, June 27th, I look at the same 90% chance of success, right? I'm collecting $475, right? $475 in 43 days, or let's go here, yep, or $218 in a week, right? I can do this over and over. And over those 40 days, I would collect about $800 to $1,200 in premium instead of $400 in premium, which would lower my cost basis in that position if I was to get assigned. Right now, I'm just going to let that trade play out for another month to see where this ends up. This, on the other hand, the poor man's covered call, is the more concerning one, right? Because I own those leaps, I can start doing this now. I can start selling covered calls on this now because it is a poor man's covered call, which means I'm selling covered calls against the leaps that I own because this is being used as a synthetic way of owning 200 shares of UnitedHealth. So what's the plan with that? Exact same thing. I'm going to start selling weekly covered calls to keep collecting premium. And here's the goal. The goal will be very small. And this is where a lot of traders kind of mess up and think about they need to keep having big wins. Let's break this down. Let's pull up a calculator so you guys can see what I mean. Okay? This right here, I'm most likely going to do on relatively daily basis when I'm looking at this, and I'm going to eke out a little bit of profit on every day. Okay? Which is probably $50 to $75 a day. I'm not even going to wait for this whole $200 to get realized. Okay? Because this, I'm waiting a week and it could go up, down, whatever it is. Because I don't want this to get assigned at 315 because my leaps will not be valued that high by that point. So the point here is going to be to do this on a daily basis when I see United going up into overbought territory and then coming down. Because this way, if it's expected to come back down or stay flat, I want to sell way up here and collect theta, which is the time decay. And if I was to do that, even if I do $50, $60, $100 a day of premium like that, the goal is going to be about $300 a week. Okay? Very, very conservative. Very conservative. Because with $300 a week, I've got 2 years left till expiration. And this is where the math comes in. Where like, well, you're down $12,000 on that trade. Hold on. How much am I down so far? $16,000. I'm almost $17,000, right? I'm down $17,000 on that trade. How am I going to make that up $100 at a time? This is where the patience comes in. Even if I do $300 a week, right? And I've got 2 years before these expire, right? 2 years. I can do this for 2 years times 52 weeks times 2 years. That's $31,000, $31,200 in premium that I can potentially collect. And now the question is going to be like, well, that depends because now you're expecting 100% win rate. No, I'm not. That's why I didn't say I'm going to do $100 a day, 5 days a week, because that would be $500. I said on average about $300 a week, right? That includes, if United was to jump up crazy, I'm able to roll out that covered call the next week and the next week, as long as it's going in my favor, which is a good sign, right? Because the goal is to not have this go to zero. And this only goes to zero if United by June 17, 2027, in 2 years, is below $300. Right now, it is below $300. But for this to stay below $300 for that long, it's gonna take a lot of effort for that to happen, number one. But if I'm collecting premium along the way, and once I've collected this much premium, this could go to zero and I'll still be profitable because I'll lose a total of $30,000 and I'll have made $31,000. Is that a lot of work? Not really, because you're letting time decay work in your favor. Let that sink in, because that is the basis of all of my strategies and why I've been profitable for as long as I have. It's because I let time decay do its thing. So if UnitedHealth decides to pop back up, does whatever, stays flat, and is just dwindling around there, and I'm just collecting premium, I'm okay with that. And I really hope this video ages well so I can just come back and be like, boom, told you. Done it before, I'm going to do it again, and I'm going to do it again. This is why long-term holders do not panic. because you always need to have a plan with a trade. Do not enter a trade if you do not have a strategy to exit it in case if it doesn't go your way. This has been a hot topic in my community chat because there's a lot of people who might be experiencing this for the first time and that are scared, and understandably so. I completely get this because at one point I was new too, and I panicked also when I saw something like this happen. But I've done it before. I've done it with Home Depot. I've done this numerous times in the past. And even with the Home Depot trade, yeah, you guys can go into my Patreon, go into the free service, and look up all the trades that I did on it. Okay? And then, of course, you have to upgrade to the paid to see what I'm trading right now. But you're able to see the results in the free, right? But so I've done this multiple times in the past. And this isn't the last time something like this is going to happen. So you really have to have conviction in your strategies that have shown to work in the past to be able to move on. And that's where I feel a lot of traders just miss out, is because they just expect things to happen. Just one trade goes wrong, they give up. This is the part of trading. If you can't handle that, I'm sorry to say, this is not meant for you. You need to be patient. You need to be resilient. You have to have, basic understanding of math to see how this can work in your favor. And all of those are learned skills. It is not no one's like born with all of this stuff, right? It's something that you can learn. So with time, with experience, you will get to a point where these kind of losses don't matter. They're insignificant because you're doing this for the long run. Could this take a year to 2 years to become profitable? Sure. It's not going to happen instantly, but at the same time, it's not considered a loss until you close out the position, and I do not plan on closing out this position. So hope this was useful and you guys learned a thing or two about the process of how you can turn losses into winners. And to all my Patreon members that I'm making this for, I appreciate you. Thanks for being a part of the community. And to all my YouTube and TikTok audience, thanks again for watching. Hope you guys picked up some stuff out of this as well. And I'll see you guys on the next one.